Hey everybody, Preston Brent here with our trader user group of Wkly Round-Up. This is for the trading week ending August the 11th, 2017. What an interesting week we had. Bellicosity, if it's a word, between Trump and the Pillsbury Doughboy from North Korea seems to have escalated a little bit as we went through the end of the week, and it caused volatility to pop. Now, we've had low volatility the entire year. In fact, leading up to prior to volatility really waking up by the middle of this past week, we've had, I think, some of the lowest vol we've ever had in the past 20 years. In fact, I don't think we've had a change in the S&P 500 E-mini futures over the course of a one-day open or close rather, of greater than 1% going back over a couple hundred days. Really amazing. But we finally got our greater than 1% close. Unfortunately, it was to the downside, but that would be expected with the low vol that we've had. And what I've got on the screen here is a daily chart of the S&P 500 E-mini futures. I've got a lot of support lines and various indicators on the screen, but I'm going to clear it up for you. And we're going to take a step back for a second. One of the things that I do in trading is after we've had a couple of really, knock your socks off, wake up jolts to the market, where it just kind of reminds you that vol, even though it's been low, can jump very quickly, is to just take a step back and define some key levels in the market. And this is very important because that is going to help determine whether this is just a simple, let's say 3 to 5 day pullback, and then it's going to end, and we're going to start grinding back higher, and vol will come back in, and before you know it, will be sub 11 on the VIX again. So we need to define these key levels, and these key levels will help determine, just how defensive we will become, and also we'll see the defensive nature of the market allocation as well. We're already seeing some sector rotation out of some technology into more value-oriented stocks from growth stocks and things like that. Now, for our members, our user group members, tomorrow night, we'll go into much more detail on sectors that are more safe haven sectors and ways that you can hedge should we really get a breakdown in the markets over the next let's say 2 to 3 weeks. But short of that, what I wanted to show you in this weekend's update is just some key levels that we need to really watch out for. So let me just clean up the screen here real quick, get some of these things off the screen. And what I'm going to leave on here are some key fib nodes. These Fibonacci's were drawn off of very strong prior pivot point highs and lows. And let me just define them for you so that you can understand, the nature of Fibonacci and just how strong and powerful they can be, not as a precise support or resistance level, but more of a zone that will either cause you to raise the caution flag or the red flag, or put the green flag back up again. And these are areas where you can expect the market to basically pull back or find resistance. So if we come in, and I'm going to define this right now with the prior pivot high, that you can see the prior pivot high on the left-hand side of the screen is the very first bar. Now, this is a weekly chart. And a couple of things I want to point out to you here. You can see the prior pivot high right at this point right here, far left-hand side. And I've defined it this way on purpose, and I'll tell you why in a second. So that was the prior pivot high. So I defined that as a key major pivot high, prior pivot high, and that was that area right there. The key pivot low was right in that area there, which was made excuse me, in early February 2016, when the markets really had a pretty good strong pullback. So these are key areas here that we're going to use to define our go forward resistance and or support points as we break out or pull back. So you can see here that at each one of these steps along the way, you can see volume over price, and you can see we've got a very high level of volume over price. This is buyers versus sellers. And who was winning this battle? right? And then you can see there's really two key areas that stick out. One is right here at the 61% fib node. And it's amazing how these things always align themselves. It's more psychological. The Fibonacci's, if you go into detail on them, and I'm not on this update, but for our members, we spend a lot more time on them. I don't use them as trigger points to go long or go short, but I do use them as zones of influence. And these are areas where we can add more or take away more in a defensive nature or an aggressive nature in the markets. But you can see these areas right here. These are the big, strong areas. And we're sitting right on this one area here, a 61% extension off this prior pivot high right here. And I've defined the edge of my screen right there, right in the May 2016 prior pivot high. So this also defines the total volume at these price levels going back for this time frame. And you can see, just exactly where all of this is. So if we look at this, and we can see that, well, we've got a high area, a zone of influence there. We got a little one right there, and we've got an even bigger one right there. Okay, so you can see these zones of influence breaking in. So this right here is naturally, this whole area here is going to be a huge support point. And you can see how we spent a lot of time here, which also happens to be sitting just on our 61% fib extension off that prior pivot high made in May of 2016, and that prior pivot low made in February of 2016. 2015 prior pivot high in May, 2016 February prior pivot low. And you can see this is a major area here that we're going to be watching for for our members. And that would take us all the way down to 2338. Okay, from the all-time highs. And you can see here we've got a lot of potential buyers that would be willing to step in the past have been willing to step in and buy the markets at this level. Now, short of any military action taking place, I suspect this will hold. Anytime you're trying to forecast a geopolitical event, my only advice to you is don't do it, because it's flip a coin. You cannot. But what you can do is look and see how price action reacts. And that's what we play to, regardless of what the headline news is. A lot of newspapers have their own agenda, both conservative and liberal, and you can't use the headline news, even TV talking heads on CNBC or Fox Business, to define whether you load up on the longs or shorts. Because if you were to talk to market professional traders, I'll find a room of professional traders that believe the market's going back down, just like we had in 2008, 2009 lows, and I'll find another room of traders that say we're going up to 2,600. You can't do that either. Everybody's entitled to their own opinion. But what is not an opinion but a statement of fact is where price action closes. And price action is going to drive this market. It always does. Now, price action, you may say, and correctly so, that it reflects the fear and greed in human nature of the market participants, which is you and me, and to many extent everybody else, really. It reflects that. And that reflection is merely castigated over into the marketplace. And we got to trade it. Now, that may mean we'll get overvalued in a rich market with high PE ratios, or tremendously undervalued. But again, the markets always overcorrect, both to the upside and to the downside. And our job is not to really say, hey, it's too rich or too poor, or too undervalued or too overvalued. Our job is merely to interpret price action and say, okay, let's see where we're going to go. So this is going to be a nature here of a longer term pullback at the 2338 area. Should we break that, it's going to get very ugly. Okay, I do not believe we're going to break that. I still think we're in a bullish frame of mind, choppy but slightly bullish. And remember, the markets do not have priced in A, a rate hike this year, and B, taxes this year. If Congress gets that done, it's another geopolitical, or not geo, but it's a political, it would be more a fiscal policy, not monetary. Should that happen, I believe that's probably what's keeping the markets up a little bit higher than they probably should be right now, given all the other turmoil going on. But it doesn't really matter what I think. Price action is telling me what we need to trade. So let's get back to that area here again. I'm just widening this thing out. And if we look at that key level, should the price action fall to that level, then we would be looking at from this key pivot high here, all-time highs, roughly from that level down to about right here, which to me is about a 6% down move, which is really more of a dip. I define dips or a pullback in the market as greater than 5%, less than 10%. Now the market defines a correction as anything greater than a 10% pullback. And then a bear market is anything greater than a 20% pullback. I defined a dip, which is not as severe as a correction, as less than 5%, or I'm sorry, less than 10%, but greater than 5%. So this would be a dip. A pullback, I'm sorry. And then a dip would be less than 5%. So right now we are still in a buy the dip mode. And if we look at this on a weekly chart, you can see where we've got another interim key level, which is sitting, my oh my, right at the 2400 level. Now, what I told our members is this 2400 level is going to be a good indication for us. If this holds up, then short of war happening and breaking out on the Korean Peninsula, then I believe 2400 will hold up. It's a natural stop-off point for the market. So the momentum of this, you can see the high and the low and the close. So this is a bearish divergence. It's a bearish engulfing candle, and it engulfs the prior 3 or 4 days. So that would mean that prior 3 or 4 weeks. So a bearish engulfing candle on a weekly basis would basically say we could get a little bit of a bounce, but I do believe we'll probably settle in just a little bit lower. So I do think a little bit lower action is what the charts are calling for at this point in time. You can see on the MACD with all these multiple crosses there, this is what we call a poor man's bed. Okay, that just means that any pullback here is probably going to be just a dip. Remember, a dip is less than 5%. Pullback is between 5 and 10%. A correction is 10 to 20%, and a bear market is greater. So just calling it that, that's kind of where I see us coming to near term. That's what the charts seem to be indicating. Okay, if we go to a daily chart, we'll zoom in just a little bit. You can see this 2400 level where it really has, the markets have bounced off this quite often, right? 2401, you can see in this area here a lot of support at this level. And surprisingly, it's a psychological number. The markets seem to have found a little bit of support in this area right here, and then coming down a much wider support area right here. Now, again, this is a daily chart, but you can see this supply underneath of buyers versus sellers. In this case, because we're higher, buyers won the battle. In this case right here, buyers won the battle. So our first rule is, will buyers pick up the slack right here and hold us up? If not, we can overextend down to the psychological barrier, because 2400 is more a psychological barrier than anything else. But you could see where it provided resistance and then support, right? And then this was the initial resistance here. So I'm seeing this next week really key for us in where we're going to go. Should we pull back a little bit more, you can see the 200 EMA sitting just north of that key area. And you can see there's a wide range right here of supply underneath where I think buyers would be willing to pick it up. And short of any, like I said, military fisticuffs breaking out, I think this will be a major holding point. So I would call this our second level of support. This would probably be our first level of support here, with an extension down to 2400. So that's the way we're going to be looking at this. The other thing is there is no bearish divergence on here. So that does suggest that it's going to be a buy the dip kind of mode. Right now with our members, I'll go into a little bit more definition on when the buy trigger, or what we're looking for a buy trigger. You can also see on the 50 EMA, and let me just go all the way back to the Trump election. in November of 2016. Right here. Let me just move it down just a little bit. Okay, so you can see here, Trump, as soon as Trump was elected, price action shot way up above the 50 EMA. Now, for those of you members that were with us that night, we were trading, and I had put in a long order on the Dow futures at 17,750. And the Dow's run up over 22,000. So we've really did well in the Dow. And you can see here, since the Trump election, all of this support with the buyers and sellers here. Now you can see right here, that's going to be overhead resistance up in that area here. So these are areas, zones of influence that we're going to be looking for on the way down. But the point I wanted to make here in this chart is after we took out the 50 EMA, every time we've tested, we extend below it because the market always corrects both up and down. We move below the 50 EMA and we come right back up. We move below, we come up. We move below, we come up. So now we're moving below and it looks like it's attempting to come back up again. If it does that, that will be a very bullish signal that the 50 EMA is going to hold up. Now the vector of the 50 EMA has turned slightly to the downside, right? And the vector of the 200 EMA is still moving up like that. So again, that compresses us into this area right here, this zone, which is what I call our second level of support on a weekly chart. So these are the things that we're setting up in our strategy sessions on the SPX and other indexes and things like that. So these are just some of the things that I'm watching for, guys, that you're going to have to pay particular attention to. All right, now when I throw in all my other indicators on here, and let's just go into a 15-minute chart for open on Monday, you can see in here we've had the 2438 area is a very strong area for price action, which also happens to be roughly about a one standard deviation move for the week. And that's kind of where we're holding up a pretty good little bit right in this area right here. And should it break, then this is going to be the area, the 2430 area. That would be on a very short term day-to-day basis. These are the things I'm going to be watching for. So this is going to be my S1, this will be my S2, and this will be my third level of support on a interim basis as we go into Monday's trading. Okay, so that is where we're sitting here on the E-minis. I'm not going to look at the others just yet. Well, I'll tell you what. Let's go look at the Dow Jones Transports. The Dow Jones Transports, let's take it back out to a daily. It's been moving down well long before the E-minis. We started moving down the middle of July. Remember, in the middle of the entire month of July, all indexes moved stronger. But you can see the Dow Jones Transports attempted a counter move, and it's just rolling back over again. This could be a precursor of the markets in Q4 going into Q1 of next year. My personal belief, which at the end of the day doesn't mean anything anymore than someone else, but looking at the charts, what I would say is the market seemed to be setting up. Traditionally, we're bullish in December, January, except in 2015, going into 2016. We could have something similar to that this year. And again, there's a lot of fiscal policy contingency here. If they don't get the tax bill done and they just kind of foil around, then we could see ourselves coming down to that strong area that I talked about on the E-mini. Now, we'll be able to trade that and make money in our group. If you're not a member, I highly encourage you to come in. We're adding members all the time. And we've got a nice little international group that's following us. So just check at the end of this video, you'll have a link to where you can sign up for us. But anyway, this is kind of what I'm looking at in the markets here. If we look at the NASDAQ for the week, let me just find it on here. Where is my NASDAQ futures? Here we go. If we look at NASDAQ futures, you can see it, in a sign of strength, regained its 50 EMA on Friday. So we're going to look very closely to see if it can hold that 50 EMA. If it gives it up, then that could be a little bit more of an early warning sign for the rest of the markets. Okay. And I can quote a lot of stats with you on the number of companies that are holding up the market versus not, the percentage of companies over the 50 EMA versus not in the S&P 500 or NASDAQ. I'm not going to do that and bore you with details. But right now, I pointed out the key levels for you in the S&P. If you forgot them, write them down, go back, replay, hit rewind, do whatever you need to do. Those are going to be key levels coming up in the first part of this week. And of course, if we look at volatility, let me find here we go. Here's vol. You can see with vol, we did what we did before. We had these key level pitch right here. And you could see that we moved up above, and we're still in the yellow zone in volatility. Over here, we were in the yellow zone for about a week before we finally gave it all up. Right here, it was 1 day. Right here, it was intraday. This is a daily chart. But if I just zoom out, you can see here that vol does not go up slowly. It'll kind of gradually move up, and then all of a sudden you get these spikes like we got right here, right? So these are the spikes that we get in vol. And generally, even if you have a large pullback, then there are great strategies to play here on these pullbacks that you've got to take advantage of as an option trader. We're in the yellow zone right now. So these are just some things that we're looking at doing here that I'm going to review with our members this Sunday night. But you can see here, it's still relatively benign. Going back right before the Trump election, you could see vol was all the way up to 23. We had this spike up into the almost the red, not quite the red zone, what I call right before the red zone, right here, right? And then you can see where the markets just really can go absolutely batshit crazy if you're not careful. So this is kind of what I'm looking at with vol. Trying to predict where vol is going to go is a losing man's game. We're going to go through some hedging techniques again this Sunday. We've got some hedges on in place right now, and we got them on before we had this vol pop. We'll take a look at what we need to do with them starting next week. Now, if you also look at the bond market, bonds is typically a safe haven when the markets move down and equities move down and volatility moves up. And sure enough, bond markets are just moving up higher. And you can see the bond market, let me just zoom out just a little bit, is fronting. These were my forecast well before they happened, where the bond market would go down here and up here. And we're just in this wide range, which also happens to be the high and the low for 2017. And right now we're sitting right here. So we're in the, what would you call this? The upper 20% of the range for the year, upper 15% of the range for the year. Why? And we're near all-time highs, guys. So why is bonds up so high, and yet we're near all-time highs in all equities? Bonds should be down in this area here, and the only reason why is high inflation or low inflation. And we've got trades that we're looking at to leverage these things for our members. We'll go through some of that and where our secret trader is this Sunday night. But there are a number of different reasons why, and this is also going to play into the monetary policy of the Feds coming up, I think, September 19th, which is the next Fed meeting. So you can see bonds risk off, bonds up a little bit higher. Now, in the currency market, after we got the inflationary data, the CPI data, look at what happened to the dollar. It gave up the move higher. I mean, this dollar is just extremely weak. We attempted a counter trend rally, and it came right back down again. I mean, if you look at the dollar, it is just extremely, extremely weak. It's getting to the point where I think Yellen is going to get on the phone with Super Mario, and they're going to come up with some kind of Faustian deal that's going to drive the dollar higher, because Super Mario has just the opposite problem. He's got a very strong euro, and it's going to make their exports in Europe go down, and it's going to hurt companies in Europe. Europe's on a nice growth path right now, and if you listen to all the TV talking heads, they would suggest that Europe is going to be the place for money over the next 6 months. But I got news for you. If the equity markets crater in the U.S., they're going to crater in Europe as well. And then money's going to seek safe havens, of which the assets I've already discussed with our members of where you want to be putting some money right now. But this is kind of where we're sitting as we speak in the US dollar. And of course, the euro is going to be just the opposite of this. If I show you the euro futures right here, you're going to see here we're near the 2017 high for euro. It's just the opposite of the dollar. We came down. We almost hit I had a low price target of about 102, and we came down to 104, 103. So I missed it by just a couple of pennies, and then we've started this nice, robust move up. Do I think the euro is a little bit richer than it should be? Yes. I was envisioning the euro around 115, 114 area on the high side, and we're well extended above that. And of course, the markets always overextend, both up and down. So we're a little bit overextended. So that's kind of where I'm seeing the euro here right now, just given where we are. But eventually, that is going to start to weigh on European equities. And then let's look at gold. You can see gold right here doing what gold is supposed to do in times of stress. It's moving higher. We're kind of regained this channel. We came right down and hit this support level that I had talked about right there. I've had on the chart for quite some time. And we've just finding support at that level around 1200. Now, we're up in this area here. For me to really get bullish gold, I want to take out this level up here. I want to see a pullback, a test, and then another higher move here. Otherwise, we're susceptible to coming back down to the bottom of this channel again. So that's, and if Yellen comes out with a more hawkish monetary policy this September, you're going to see gold roll over a little bit. So this is kind of where we're sitting here. The only thing that's given gold a boost over the past 2 or 3 weeks is the geopolitical risk that we're seeing in Korea right now. And then, of course, if we look at one of our favorites, oil, we've had 14 trades in a row of successful trades on oil. 14. And we're on 15 right now, and it looks like it'll be number 15. So for our members, we're really pulling some nice money out because the average days in trade for our oil trade is less than 14 days. It's around 12 days in trade. And you can see we're making lower highs and lower lows. It's attempting to break this downsloping trend line, but every time we break, we have a retest and it fails. So we're sitting right on the 200 EMA. I think oil is going to probably, I think eventually what oil is going to do is probably do one of these things and come up, test that area, and do one of these things like a cup and handle kind of thing. But it's not going to get much higher than this right here. And then I'm going to be interested in shorting again. Right now, we've had some great trades. The strategy that we're using is working out well, given the environment we've got in the oil and the energy complex. So we're just going to continue playing that as it's given. All right, everybody, that is my short and sweet update for this prior week for our members. I will see you this Sunday night at 8 p.m. New York City time. Of course, if you missed it, it'll be recorded for you. You can play back anytime. If you're a non-member, I highly encourage you to come in. We're making money in these markets. If you're missing out, then I think it's costing you money. So, and we play all markets. We play equities, commodities, futures, options on these things. And we're also getting into some stock plays as well, where the option liquidity is relatively weak. So have a great weekend, everybody. Members, I will see you tomorrow night, 8 p.m. New York City time. Ciao, folks.